Hey, good afternoon, and thanks for joining us this afternoon for the this episode of Long Beach Post's daily talks with people in the community. Today, we're being joined by Lauren Boland. She's the owner broker of LBL Mortgage. And before we get into talking about some of the issues that homeowners are facing right now, I would like to invite anybody watching, if you guys have questions during the span of this conversation, feel free to send them in, and we'll make sure to ask Lauren them, assuming we can squeeze them all in. So, Lauren, how's it going?
It's going good. Thanks for having me. I think this is so exciting that I've been watching the other ones that the Post has been doing, and I mean, what are we all really doing at 1:00 in the afternoon, other than going on Facebook or tell our pet how much we love them?
Right.
So we like to explain a few things that are going on, and touch on some issues, and also answer questions if people have them, specifically about forbearance or what's happening with lending in general, tightening of guidelines.
Yeah, and you brought up forbearance because I think, that's one of the biggest concerns right now for everybody, whether you're renting or making a mortgage payment, is that a lot of people in the state and across the country have either lost their jobs entirely or have had hours cut, and now are still being faced with the same monthly payment that they had before, but with less money to do it with. So there's been a lot of publicity about rental assistance programs that have either been passed, adopted, or proposed at the state and local levels, but there have also been things that have been passed for homeowners, and one of those things is forbearance. Can you kind of explain how that works?
So the first thing I want to explain about forbearance is forbearance does not mean forgiveness. That's not what that means. Forbearance means time out. The biggest use of forbearance has been with student loans, actually. So with mortgages that are backed by Fannie Mae, Freddie Mac, FHA, or VA, you have the ability to call your servicer, and your servicer is who you write your check to every month. I think you and I talked about this, Jason, like you did a loan and then it was Quicken, and then all of a sudden you had to make your payment to another company.
Right.
So those companies do change. So the servicer is the one that determines whether or not you're going to get the forbearance. Even though the HOPE Act was to help, all of us, whether it was with a PPP loan or forbearance or, all let's call it the bailout, right? The COVID bailout. Your servicer is really the one who puts together the documentation to give you approval to be in forbearance or timeout. And then generally it's for 3 months. So what we saw in March was a slew of people calling in who had either lost their job or seen a decline in their pay. So they're not working as many hours or so on and so forth.
Yeah.
So they were given 3 months. And then in July, the agreement, most of them that have been offered July, they'll have to come in with the 3 months plus July. So they'll have to come in with 4 mortgage payments. We are, now that it's May 13th, right? So this is 2 months in. We as an industry are starting to see that's really not possible for people to do. So the servicer, again, it has gotten permission from Fannie Mae to add that specific part of the forbearance on the back of the loan. And
so basically, if your loan was to what's the word that they use, mature, like you're set to pay it off maybe in June 2030, you could now add the 3 months and you would be at September 2030.
Correct. Or if you refinance any time in the future, it will be added on to your payoff.
Right. And there were reports of some companies doing that in the first place. And then, like you said, some others were requiring the total to be paid all at once, which is, I mean, depending on what your mortgage payment is, that's a lot of money to pay.
A lot of money.
Yeah.
So the original plan and again, every servicer can do what they want, because a lot of people don't realize this, but servicing, well, basically there's three profit centers in the mortgage industry together. There's origination, which is the customer to the broker, like somebody like me, right? And we write the loan and we fund it and they have a new loan. And then after your loan is funded, it's purchased by the secondary market, but the secondary has to have kind of a partner in crime. And that partner in crime is the servicer. And they have to work together to make the whole system work. And it's interesting, but it's also complicated. And so the servicers, part of the way to play the game with them is that they have to make your payment for you, whether or not you make it to the secondary person who owns your loan. So the servicer has the right to say, okay, I'll eat these 3 for now and you'll pay me back later, but starting July, you need to start making regular payments. And if you don't, then we can begin foreclosure proceedings. Like, so our agreement is null and void. So that's kind of where it started. We'll give you a break, but you're going to get if you don't, at some point you have to start paying again.
Right.
So now we're here in May. Look, we're going to be on lockdown till July. So that's, again, there was a plan. That plan is not going to work. So now there needs to be a new plan. And I see Congress giving the servicers money to make sure that they have the liquidity to keep buying new servicing mortgages that are being done, because rates are still at a very, historic low. We're seeing rates at the low 3%. So we still need them to do their job. But at the same time, we still need to give homeowners relief, because this is unfair.
Right. And that's what I was going to ask you was, before we went live, you were talking about how you read all of these, I guess, journals in terms of real estate goes. But I mean, has there been I think you said that there is an indication that there's going to be some flexibility with possibly extending this program for homeowners?
Yes. So the servicers, they threw a big, let's call tantrum back in March. And no, they really did. And so we actually were told for about a week as an industry that all of government lending was going to just take a pause and they weren't going to fund anything, which wasn't true. But you have to understand, when 4 million people at one time don't make a mortgage payment, banks are in the business of lending money and collecting payments. That's the give and take. And it's based on risk. So you can't assess COVID as a risk when you write a loan. Does that make sense?
Right. Yeah.
You can't. How were we really? I mean, I missed the Bill Gates TED Talk in 2015 where he talked about this. I missed that. So really, the market had to figure out a way to deal with so many people at one time. Even during 2008, when we started to see, 2008, 2009, we still didn't see people stop making payments all at one time so quickly. So it was a big shock to the system. And Congress, I'm pretty sure that Congress is going to give a bailout to the servicers, which will flow through Fannie Mae and Freddie Mac and FHA,
right?
And all will be well. And let's remember that Fannie Mae and Freddie Mac make billions of dollars off of writing these loans. They are a very healthy part of our government as a GSE. So, GSEs are like the post office, right? So there's an unhealthy business that the government, has, right? They lose money, they lose, billions every year. So on the other side, Fannie and Freddie, they do have the money to help the servicers, but there's big negotiations that have to go on. Because at the end of the day, these loan programs are designed to give Americans mortgages and provide financing that is clear, concise, and available.
Right. You brought up 2008, and I mean, unlike
it was rough.
Unlike previous disasters, you don't have to say like, oh yeah, if you were alive, most people were alive 10 years, 12 years ago and know exactly what happened. And I guess my question is what is the prospect of that happening again? Because I mean, like you said, in 2008, you didn't have 4 million people stop making payments at once. It was kind of a build-up.
1 month, you didn't have that, no. Right. So a few things were different back then. One, over 40% of people in the United States had short-term adjustable rate mortgages. So what happened is that people couldn't refinance out of those short-term adjustable rates. And so they just walked away because their payment quadrupled because there was no set, there were no set laws on how to write these things. And the borrower was not understanding it. It was the Wild West. There were no rules, and Wall Street took full advantage of that.
Right.
So today, I mean, 98% of mortgages are 30-year fixed, 15-year fixed. So we're not going to have somebody who in 3 months is going to have their payment go up 3 times. So there's that stability. Does that make sense?
Yeah.
Also, the majority of loans that we do have out in the country right now are either in the 4% or the 3%, which are historic rates as far as if you have tracked what interest rates have been in the past. Mm-hmm. I mean, in the early 80s, when I was just a little baby, 18% was the going rate for a home loan.
That's crazy.
Right? Isn't that crazy? But people still bought homes. They still, they refinanced. They used adjustable rate mortgages back then to kind of give a little relief, but we've come a long ways. So I don't see that happening. Also, Dodd-Frank put in place a lot of regulations that held lenders accountable, but also borrowers accountable. And prior to 2008, we had a lot of people, and it was probably happening on both sides. The industry was, influencing it, and the borrowers were, but there was occupancy fraud. And that's where somebody will say, oh, I live in that house down there. So, and but I'm going to move to this house and I'm only going to put 5% down. So we had a lot of people who owned multiple properties with very little equity. So we don't have that now. We have equity. People have equity. They may not be able to access it after this forbearance. We don't know. That's still kind of in the works.
Right.
But we have things that we didn't have in 2008. If I answered that.
Well, that's promising. There hasn't been a lot of promising news in terms of economics for anybody. So that's good to know that we're not going to have possibly a Big Short part 2 having to be made about.
No, there won't be a Big Short part 2.
So we have our first question from the audience. So you've referenced Fannie Mae and Freddie Mac. What if you don't have your loan through those? How does that have you impacted?
Okay, so it depends when you got the loan. So if you got the loan a long time ago and have just never refinanced, you can call your servicer. They'll work with you. But if you have what's called a non-QM loan, so maybe you got it through a bank statement loan, or it was they call it a business purpose loan. That entire side of the industry has stopped lending altogether. So they are definitely going to want to work with you, but I don't know what those terms would look like because the companies that wrote them literally closed their doors and went out of business. So I hope that answers it, but there aren't that many of them out there. But for that little section, they're going to want to work with you because, again, this isn't because we all did something wrong, that we were buying cars and going on extravagant vacations and so on and so forth. We literally were told by the government we couldn't work.
So you just brought up cars, and I know your expertise is homes, but another question just came in that said, I know you handle mortgages, but do you see possibly the same kind of flexibility with other loans?
Yes, absolutely. With car loans, no one is buying a car right now. And I don't know if you just watch the commercials but Ford will literally pay 3 months of your payment and defer 3 months. So you can buy a car from them today and not make a payment for 6 months. Auto lenders have been struggling for a while with defaults because these are trends that in lending that we look at. If you're struggling in one area, they're absolutely, communication is key. You have to call them and tell them. Also, with anything, have paperwork ready. If you were sent home and not allowed to work and you're not getting a paycheck anymore, your job has probably sent you some type of direction, or there's a way to document it. Have that ready to send to them, because it's a lot easier to call up your servicer, whether it's for your student loan or your car payment or your mortgage, and say, hey, I have this documentation. And definitely going forward, especially after July, these servicers are going to want to see these things. And for good reason, right? Because unfortunately, a few bad apples will spoil the bunch. And there will be people who, would just want to get a free ride. And then they ruin it for the people who really need it.
So speaking of bad apples, when we were talking offline, you had mentioned, the prevalence of scams now involving mortgage related issues.
Yes.
It seemed like almost instantaneously when this stay-at-home order went into effect, my phone started blowing up with text messages saying that my Netflix account had been hacked. And, so obviously that's a scam, but what have you heard in terms of how these scams are working in terms of real estate scams?
So I guess it's just kind of experience. I've been 18 years in the lending business. Humans are actually quite predictable in certain circumstances. And we are all very vulnerable right now, whether you're a business owner or you're at home, or maybe you're working, but you're working from home and your kids are home having to, be on their phone to see their teacher. We're all very vulnerable, and there are criminals out there that take advantage of that. And my big worry is, as more and more of us as more and more homeowners file for forbearance, and then July comes and we realize that, okay, we're not going to be able to make those 4 payments, and there's a new agreement drawn. This information that you're in forbearance, there may be something that is filed, or it's easy for the bad guys to find out that you've done this, and they'll contact you and say, hey, if you give me some money up front, maybe I can negotiate a better deal for you, or I can get you a loan modification. Though that was a very prevalent thing back in our last crash. And I mean, anybody was saying they could do a loan modification because people weren't making payments, but they still had money coming in. So again, very different than what's going on now. And so these companies would say, well, you would be making a $2,000 payment, so why don't you give me $1,000 a month and I'll get you out of this? And that was just a big scam because they didn't do anything, and all these, most of these people ended up losing their homes anyways.
Right.
So I worry that that's going to come around again, because desperate times brings desperate people. So if somebody wants to talk to an attorney about a loan modification or something more, they can go on the Department of Real Estate's website. It's www.dreca.com. And there's a list of attorneys that are approved by the Department of Real Estate that you can talk to. And guess what? They're not going to take any money from you up front. It's usually, if they do the job, then you would owe them some money. So I guess it's just kind of buyer beware. Don't ever give anybody money up front for anything.
Right.
And not the Canadian lottery. And as always, the IRS never calls you. They send letters.
Don't trust the guy whose phone number's stapled to the telephone pole, right?
Exactly. Or the guy who says he can sell you a foreclosure. That's a handwritten Sharpie sign.
Right. So I know you said that you don't think that this is going to and I hope you're right, that this isn't going to be 2008 revisited, but what is the impact on the market? Are home prices going to go down, or what does affordability look like?
So I am, okay, so first of all, I'm not a real estate agent. And actually home sales were up this month, believe it or not. I heard that statistic today. We saw a little bump. But lending is really the precursor to what real estate's going to do, because if people don't have, if the lending guidelines shrink down, then that means people get less money to borrow. And if they have less money to borrow, the next thing that goes with it is a decline in real estate prices. And now there might be a real estate agent that will say, well, they could just bring more money in. Well, yes, they could. But are we really there as a country where people have this extra cash to make up? No. People finance properties. Popular lending products are 10% down. FHA 3.5% down. And those products will still be there, but the requirements to get it will be stricter, which means less people will qualify for it. And unfortunately, when you start shrinking affordability, home prices shrink too. It's just it's the nature of the game. I don't know how far it's going to go, but if you look at the indicators that we had in the past in the Great Recession, and you look now, they're very different. Things are very different. So we could bounce back from this quickly. It all depends on what the federal government does as far as band-aiding up the servicers, for example, right? If they don't get help, they're not going to be nice. But if they don't get a bailout, and Fannie Mae actually has to pay for this, what will happen is that so Fannie Mae makes their money on these things called loan level price adjustments, and it's a fee that all loans get assessed, and that goes directly into Fannie Mae's pocket. Well, they have started already to make a fee that was 1%, now it's 2%, and so Fannie Mae just may come in and make these fees bigger, which will push rates up, which will push affordability down. Oh, I hope I made sense of that there.
No, you did. I'm monitoring these questions that are coming in. So we're popular, Lauren. We got 3 questions, but I think I'm going to tie them all together because they're all kind of similar. So people are wondering, is it a good or a bad time to sell a home right now? In terms of the pandemic affecting home prices.
If I could give people advice, I would say, so if you're okay with selling your home and renting for a little bit and watching what happens, then, that could be definitely a strategy. If you sell your home, there has to be a buyer out there. And, that's my only concern is how long, what if we get another wave in the fall? And it's like, and it's worse than, we had deaths in Long Beach, right? But let's look at the county and the state as a whole. If you want to sell, you sell. There's plenty of real estate agents out there that will make you a great deal on a listing. And there are buyers because, and that's a really good point. Should they sell? How many people are wondering now because they've been stuck inside with their significant other and their family for a few months, which I don't think is that wasn't how nature wanted us to be. Right? I mean, every day. So I think some people are like, I need more space. So, that might be, or they live in an area that, unfortunately there's pockets of Long Beach that are really ridden with low level crime because there's not a lot of activity in certain areas. So the element has descended and they're not feeling as safe. So, maybe you want to move for those reasons, I think that's a great idea. If you have the equity and you can qualify for a loan, because you're working, by all means, participate. or
Right.
get yourself a more comfortable place.
And the pandemic, obviously, in not just in real estate, but in almost across the board, nobody has been affected the same. So people who are working are kind of in a place where they can kind of take advantage of this pandemic. That's a terrible way to phrase it, but refinancing, if you still have income coming in, is refinancing a positive note. Since we do have a few minutes left, I want to save maybe a positive note for the end. But
sure, what I've told people, especially people who might think that later on their hours would be cut, even though they may have to take a slightly higher interest rate to cash out, we all function better as human beings when we feel safe with what our money situation is. We might not have what we want, but if you get what you need, you function better. And there are some people that would benefit from doing a cash out refinance, have some money in the bank, pay off some credit cards, keep those monthly payments down, and have peace of mind. And then that way, if there's another wave of this and there's no work, you're safe, you're okay. That's harder to emotionally get through. A lot of people get stuck on, but my rate is at 3.5, and if I cash out, it's going to be 3.75. Oh, but it's hard. It's hard to get past the emotional part of doing something to help you in the future.
But
if somebody has an interest rate at 3.75, rates are hovering, at least for what an independent broker like myself can offer, are hovering at the 3.125, 3.25 every day.
Right. So if you're not in the market to sell, you want to stay in your house, but you want to potentially lower your monthly payment by a few $100, that is a possibility depending on what your credit score and current incomes are right now. Yeah.
Absolutely. And there's also tools today that we don't have to pull your credit. We can just do what's called a soft pull. So it's not an inquiry, and we can see your eligibility through that.
Well, that's good news. I mean, we spent the first 29 minutes of this talking about all the terrible news happening in the housing market, which is kind of mirrors the bad news that is just everywhere right now. But
I think the good news is we're all going through this together.
Sure.
And I think it's made us appreciate certain things. And the real winner are our pets, right? I mean, my dog is so happy because I am there. I had to come to the office because the internet's better here. But I think the real winners of the lockdown are dogs and cats.
Yeah, and soon, based on city council discussion last night, you'll be able to have 5 more potentially. So you can get 5 more dogs if you're able to stay in your house.
I'm all about it. You got to go down to the Long Beach Animal Shelter. Go get yourself a lovely, lovely animal. They have the best. And those senior animals, they love you so much because they've had a rough life.
See, every conversation should end with advocating for adopting a shelter dog. I feel like that's a positive note to end on.
And the cat, don't forget Mr. Butters, the legacy of Mr. Butters there.
So I forgot to introduce myself at the beginning. I'm sure there's a lower third down here, but I'm Jason Ruiz. I'm a reporter for the Long Beach Post, and this was Lauren Boland. And I hope that I hope she answered some of your questions regarding the real estate market and some of the issues that hopefully some of you aren't going through, but if you are, maybe some of the solutions.
And Jason, if people have questions, they can visit my website, and my contact information is there. And I'm more than happy to answer questions about, if they are in forbearance and they don't understand the document, so on and so forth. So I'm a wealth of knowledge when it comes to these things, and I'd love to help somebody here in Long Beach who maybe feels lost.
Awesome. Well, we appreciate you coming on and sharing some of that knowledge. And if anybody does have questions, it's LBL Mortgage, right?
Yeah, lblmortgage.com. Yes.
Perfect. Well, thanks everybody for watching, and thank you, Lauren, for coming on.
Thanks for having me on, Jason. Yeah. Okay, guys.